that is coming.
It is coming like a ticking bomb.
Outside. Okay, guys, let's start. All right, let me just. Is my PC hanging again? I think we have the same problem. All right, we finished on. I need to reduce the size here. We finished. We were dealing with swap-driven issuance. Can you guys on the last bench? Can you see, Sina?
Yes.
You can see. Okay. All right. Now. So the point that was already raised by Dipanshu and partly by Gaba in the previous class is that swap-driven issuance can also involve two different currencies. Okay, so I'll just show you that example. Now we are referring to. I've just clustered the text together. I'll split it up because there's a reason for doing that, because I want to discuss. I want to capture these two images in the same view. That's why I've clustered all the text together. It looks unfriendly, and I'll change it later on once we have covered this topic. So swap-driven issuance can involve two currencies as well. Let's open that book once again. So you already saw swap-driven issuance where the issuer initially issued wait for it to open. Initially, the issuer issued in floating rate dollars and then swapped into fixed rate dollars using a fixed floating IRS. Remember that? Okay. So we are now going to look at a case. So that we said there's a case of swap-driven issuance. I think that was on page 7. Yeah. This thing is, I don't know how big it is. Is it? All right. Here we said that what you see in Figure 1 is a case of swap-driven issuance, because the reason we say that is because there's no natural there's no natural desire on the part of the issuer to issue in floating rate dollars. So it's a kind of an artificial issue in floating rate dollars, which you see, because he's only doing it there because his investment banker has told him that there is investor demand in floating rate dollars for floating rate dollar debt. So issue there, and then we will give you a swap into fixed rate dollars. Okay, so that's why we say that this floating rate like the figure one phenomenon we say is swap-driven issuance. That's a PCM transaction. Okay, in the DCM, in debt capital markets. So this is what you have. So the point here is that in this particular example, all the cash flows are in US dollars. So this is your swap, okay, where the two cash flows are exchanged, and both the cash flows are in US dollars. So the point that Dipanshu brought up was that, of course, you can have this even in two different currencies. So refer to Figure 16, the middle panel on page 14. So let's go to page 14. Okay, so we will study those categories of swaps. So by middle panel, I mean this part, the periodic payments. Okay, this is the example that somebody was talking about exchange of principal. Who was it yesterday that was talking about exchange of principal? Somebody was asking about, I think you were asking about how does the dealer manage the risk and all that. Okay, so these transactions are fairly complicated, and so the dealer would have to take all the risk management decisions, whether to hedge or not to hedge. Okay, but we just focus on the periodic payments because this figure is not created to show swap-driven issuance, but I'm artificially showing swap-driven issuance. I'm going to focus on the right-hand part of it, which is the part between SCB and XYZ Corp. Okay, so here again you can see, we can imagine that this is swap-driven issuance. This particular issue that you see that these guys have made. Okay, you can actually see the issue in the first part where they issue a bond and they get $150 million. Okay, that's the bond issue proceeds. Okay, we are assuming there's no underwriting fee, etc. And here they are paying this kind of fee. So this is a what? Floating rate debt instrument or fixed rate?
Both.
Yes? What both? No, I'm not. I'm talking about the debt issue that XYZ Corp has made in this particular figure. Is that a floating rate issue or a fixed rate?
Fixed.
Why do you say that? What interest are they paying? What interest are they paying?
Floating over.
What interest are they paying in the middle panel on the right hand side here? Forget about the left hand side of this panel. They are paying what? What are they paying here?
Exactly, LIBOR rate plus 50%.
So here it doesn't mention what, let's assume it's 3-month LIBOR, okay? So if they're paying 3-month LIBOR plus 50 basis points on a debt issue, is that debt issue a floating issue or a? It's floating. Should be straight away apparent from the word LIBOR. The moment you see the word LIBOR, it means that it's a euro deposit interest rate, okay? So it must be a floating issue. Okay, so it's a debt instrument where they have issued that debt instrument. They got $150 million as issue proceeds. Okay, and now they're paying her LIBOR plus 50 basis points. So this is a floating issue. All right, this is clear to everyone?
Yes.
Okay. All right. So now they've issued that debt instrument. Now, as I said here, we are artificially considering this is another case of swap-driven issuance. So, which means that XYZ Corp had no interest in issuing floating rate dollars. They have no interest in that. Let's assume that they are a British company. Let's assume they're a UK-based company, and all their revenues are in British pounds. Okay. So, if you're a UK-based company and all your revenues are in British pounds, what is the prudent risk management? As if you are going to be a prudent risk manager, in what currency should you issue debt?
Sir,
Is my question clear?
Yes.
Yes or no, Sahil? Yeah. If you are a British company and all your revenues are in British pounds, as a prudent risk manager, in what currency should you issue debt? British pounds. Okay, you should match your revenues. Revenues are your assets, and debt will become a liability. Okay, so you should, the prudent principle is you should match your assets and liabilities. Okay, so therefore you should issue in British pounds. But once again, the investment banker tells them that there is no investor. Let's say whatever this is, I don't know how long. Let's be consistent with the example. Whatever it says here, maybe whatever the number of years, okay, 7-year swap, okay, so it's a 7-year swap, let's assume, okay, so they want to issue 7-year fixed rate sterling. They want to lock in their rates as well, their funding costs. They don't want to have any uncertainty. So XYZ's preference, the CFO of XYZ would prefer to issue in fixed rate sterling, okay, because he wants to lock in his interest cost and he doesn't want to have a currency mismatch. All right. So, but the investment banker tells him that, sorry, there is no investor appetite for $150 million of debt in the fixed rate sterling debt markets. Nobody wants to buy this fixed rate sterling bonds. Okay, and as I told you, because of all kinds of restrictions on the institutional investors who buy debt, you will very often face these kind of situations where there is some kind of an odd mismatch. Like there's no demand for selling debt in fixed rate yen, but there is some demand in floating rate Australian dollars. Okay, so these kinds of dislocations, mismatches will always be there in investor preferences. So the investment banker tells him, sorry, there's no demand for selling fixed rate sterling debt, but there is demand for floating rate dollar debt, and the swap is favorable. Okay, so suppose their target cost of funds, let's assume, is 11%. Let's say for cost of debt, their cutoff is not more than 11%. Okay, are you following? If you don't follow at a point of time, please ask. Okay, so let's assume that because every treasury is going to have some kind of limit, you can't expect them to issue debt no matter what the price. Okay, so they will have some kind of, let's assume that their cutoff is 11%. Okay, so then the investment banker tells them, because remember the investment bankers are monitoring both sides. They are monitoring because they have a swap desk as well as part of their market making operations. Okay, in interest rate swaps, so they have a swap desk as well, the big investment banks. So the swap desk will tell them that these are the swap prices, okay, and they will tell you that you can swap from fixed rate sterling. You can have a swap where you have 10.5%, where you pay 10.5% in fixed rate sterling. You can see this part of the swap here. Okay, so they get this pricing from the swaps desk, from the market maker on the swaps desk. So he tells you that if you want a swap where you receive dollar LIBOR plus 50 basis points and you pay fixed rate sterling at 10.5%. If you want a swap like that, this market rate is available right now. Okay, so then what happens there is the investment bank, the distribution side, the distribution team on the investment bank is able to figure out from the investors that they are happy to buy 7-year FRNs. Okay, they're happy to buy a 7-year FRN for 150 million. At a pricing of dollar LIBOR plus 50 basis points. Okay, so if you combine that debt service liability here with the swap price that is available from the swap desk, okay, you can see that XYZ Corp is able to achieve its target currency liability profile. We use the word liability profile here. All this is written down in your notes already, so you'll have enough information there. Just try to understand the concept, okay? So this we call a liability profile, which means when you look at your liabilities, your debt, okay, what is the currency denomination of the debt, okay? What is the tenor of the debt? What is it, floating rate or fixed rate? All these aspects, we call it the liability profile. Just like we have a student profile, we look at the students, we say, okay, what did he do in his undergrad? What grades did he get in his first year? And things like that. So these are all aspects of the student profile. So similarly here, the liability profile, typically you are concerned with how much debt is there in a particular currency, what is the tenor of the debt, whether it's fixed or floating, all these things. So we say here that XYZ Corp, through the swap, okay, on a net basis, if you consider the hedge position and the underlying position, remember here, this is the underlying position, because they are forced to issue in floating rate dollars even though they don't want to, because that's where the investor demand is, okay? And here they do a swap, so this is the hedge. Is this clear? Because here they don't want to have this underlying position because there's a currency mismatch, and they also don't want floating rate debt. Okay, so they do this swap as a hedge. This is the underlying position, this is the hedge position. Okay, so but net of the underlying, because the only thing that matters is the net of the two, remember? The hedge position plus the underlying position is what you are concerned with. Okay, when you have not hedged at all, your hedge position is zero, so all you have is the underlying position. So when you look at the net of the two, then do they have, what is their net cost of funding and what is the profile? XYZ Corp in the middle panel. Wake up, everybody.
So that 10.5% LIBOR plus 50 basis points.
No. Rahul, what is XYZ Corp's net cost of funding after doing the hedge? In what currency? In the middle panel. Is my question clear? Net of the underlying position and the hedge position, what is their net cost of funding? You look at the middle panel on the right hand side. Is this right for you as well? Yeah. On the right hand side, in the middle panel, you look at XYZ Corp's underlying position and hedge position, then you tell me what is their net cost of funding in what currency, whatever. Yes, Prachi, can you help? What happened? Is my question clear? So, what is your answer? LIBOR plus 50 basis points. That's their net cost of funding.
No.
Okay, what about Vaibhav? No? Pallavi? No? Is my question clear? Why is my, okay, what is not clear about my question? I am asking you, you are already familiar, having done the previous project in the previous course, the concept of underlying position and hedge position, that once you start hedging actively, the only thing that matters is the net of the two positions, right? Your underlying position plus your hedge position. You have to see the net position. Okay, so here, is there any lack of clarity about what is the underlying position? Sina, is there any lack of clarity about what the underlying position is? You give him the mic, give the mic to Sahil. Sina is not clear? So why, if you're not clear, why aren't you asking questions? Why are people? Is my question clear? So my question is, what is, if you include the underlying position and the hedge position, and I've already explained to you what is the hedge position and what is the underlying position. Is there any lack of clarity about those? About what is the underlying position, what is the hedge position? So what is so complicated about this? Is like just looking at some pictures and figuring out. This is so easy. Its answer is there on the sheet, on the panel itself. Yes, Sahil, go ahead. Sorry?
I'm not sure, but
Yeah, just tell me whatever you feel. Yeah.
the underlying position is LIBOR plus 50 basis points and the hedge position is 10.5. Then the net will be LIBOR plus 50 minus 10.5.
Still not satisfactory. Anybody else wants to answer? Ishan, can you help us? No? Okay. You don't want to help us or you can't help us? Okay. Yes. Anybody else? Who else? Dina, will you help us? Not clear? Dipanshu will help. Give him the mic. My question is clear?
So you are asking that.
I'm just asking what is your net, like suppose your underlying position is you were long $100 million worth of crude oil, okay? And then in your hedge position you sold $50 million worth of crude oil, or $70 million. In the hedge position you sold $70 million of crude oil. So your net position is your long $30 million of crude oil, worth of crude oil,
Difference.
right?
Difference.
1 minute, yeah. So what is the net position of XYZ Corp?
What is the difference between the 10.5 and this LIBOR plus 50 versus?
Okay, let's not waste any more time. Okay, guys, now just one sec. Just switch off the mic and I'll tell you. Okay, look at this. Now, what is so complicated about this? This dollar LIBOR, this is going out, outflow, you understand?
Yes.
Why is this going out? Because they have issued a 7-year, $150 million FRN at dollar LIBOR plus 50 basis points. Okay, 3-month dollar LIBOR plus 50 basis points. So every 3 months they have to pay this amount, whatever the LIBOR fixing is. Okay, so that's one part of the, this is the underlying position. Okay, the underlying debt position. Now they've done as a hedge transaction, they have done this thing is called a cross currency. We'll look at the taxonomy later on, but this thing is called a cross currency interest rate swap. Okay, because it's got two currencies. Okay, that's why we call it. You already seen the IRS.
Yes.
If you assume that the sterling thing was not there here, okay, if you assume that the sterling thing which I have hidden with that cursor, suppose this 10.5 was a dollar interest rate amount. Okay, it's a dollar fixed rate. Then this transaction you've already seen before.
Yes.
In your figure 1 and figure 2, you've already seen this transaction before,
Yes.
where one party is paying a fixed rate, the other party is receiving paying a floating rate. Okay, so all we are saying is now we are just changing the structure of the swap a little bit. Instead of having only one currency, we are doing what Dipanshu was asking for yesterday. We have now two currencies in the swap. One leg is in sterling, one leg is in US dollars. Okay, so this thing is called a cross currency IRS. Okay, we'll give you the notation and all the names later on. You don't need to note down anything, but just understand this. That's all we are doing. Is everyone clear about this at this point?
Yes.
Okay, so this is a hedge transaction. Yes, Akanksha? What part is confusing? Your expression says that you are not happy with the explanation. You're not fully on board. So which part is not clear? Yes? No need to be shy. Just tell me what is not clear. I mean, you seem to be not clear about something, which not in agreement with what I'm saying. Which part? Give her. Achha, you missed a class. You definitely need a mic because your voice is quite soft. Okay.
Sir, in this class, I am not clear about the concept, so I have to listen to the audio.
Yeah. Now it's no longer audio, so now you can look at the video and see, because then you'll get the chart as well. Okay. All right. Okay. So fine. So now, okay. So what was I saying? I was just explaining. Okay. So the net position. So the underlying position is clear to everyone. They have to service a floating rate liability. They have floating rate debt because they issued an FRN. Okay. So they have to service this liability now to the investors. They have to pay them every 3 months. They don't like this because they have only sterling revenues and they have to service dollar liabilities, and plus it's a floating rate liability. They don't want any of this business. They want to have a liability profile that is fixed rate sterling. That's what the treasury wants. Okay, that is the preferred liability profile because that will match their currency of revenue currency, and it's also fixed rate debt. It's not floating rate, so the cash flows become certain. Okay, so they're a conservative treasury. So therefore what they do is they ask for a price from Stanchart for a cross currency IRS, and Stanchart says that okay, if you want to, because what they want to do is they want to match the dollar liability. Okay, so they ask Stanchart to give a price on an interest rate swap where XYZ will receive floating rate dollars 3-month US dollar LIBOR plus 50 BP. Why did they ask for this kind of pricing? Because here they don't really need to. They can just ask for 3-month dollar LIBOR, and then the $50 BP extra will be a fixed rate cost for them, but that will remain in dollars. So they want to match, they want to completely remove the currency risk. Okay, so they ask for a price on an interest rate swap where they will receive dollar LIBOR plus 50 basis points on the floating leg. These two legs are called, this is called the fixed leg and this is called the floating leg. Not too complicated. There are two legs to the swap, just like you have a stool which has two legs. Okay. So there are two legs, you have two legs, you want to have three legs in the stool, so we'll give you three legs, okay? So we'll give you, so here the swap has only two legs, okay? One floating leg, one fixed leg, all right? So what XYZ is saying to Sanchard is that give me a price for a cross-currency IRS, Sterling USD cross-currency IRS, where I will receive 3-month dollar LIBOR plus 50 basis point on the floating leg. Now you tell me, in exchange for this, how much do you want me to pay in fixed rate sterling? Is this clear? Is this question clear to everyone? Nikhil, you're not following. Which part are you not following? No, I'm not giving a question, right? My question was, what was the net position? My question was, what is the net position? You understand you understand underlying position, hedge position, you understand all that? Okay, so my question is that, so what I'm saying is, this is the underlying position because of their liability that they have taken on, they have issued an FRN, so now they have to pay this 3-month dollar LIBOR plus 50 basis points for 7 years to investors. So that's their underlying position, okay? Now they have put on a hedge transaction, they want to put on a hedge transaction by means of a cross-currency IRS, because the net result that they want to achieve is they want to achieve a situation where their debt is denominated in fixed rate sterling. Okay, their debt is denominated in fixed rate sterling. So obviously, just like you remember earlier in your risk management project, when you want to hedge, you don't disturb the underlying position. You keep the underlying position as it is, okay? You set up a parallel position through your hedge book, right? But the parallel position is such that it offsets your underlying position, so that on a net basis you are hedged. Okay, that's the idea of hedging, all right? So, so what they do is, they want to create a net result where they are paying fixed rate sterling on a net basis. So what they want to do, so think about how you would ask for the swap to be structured. You look at your underlying position. What is your objective? You want to cancel out any dollar liability, and you know that in a swap, what happens in a swap? So far, you've already seen now two types of swaps. You have two opposing cash flows. One party is paying fixed or floating, and he is receiving floating or fixed. Is this much clear to everyone? The structure of a swap, okay? That is how it works. It's a swap, so there's an exchange, okay? So they are going to ask for a price for sterling USD cross-currency IRS, okay? So what do they want to do? They have if you look at their objectives, you will figure out what kind of swap they would want to have, okay? What do they want to have? First of all, they don't want to have anything to do with the floating rate dollar liability, all right? Because they have no revenues in US dollars and they don't like floating rate risk, okay? So therefore, in whatever swap they do, okay, in the hedge transaction, you know that the swap will have two cash flows, two flows. One is the floating leg, one is the fixed leg, and they will receive on one leg and pay on the other leg.
Yes.
That much is also clear because it's a swap, so it has to be equal. You can't receive on both the legs, or you won't pay on both the legs. You receive on one hand, and with the other hand you pay, right? So that is what a swap is. So you know that as well. Now if you think about what they want to achieve, you'll be able to figure out what will be there on the two legs of the swap, how the swap will be structured. So the first thing they want to achieve is they want to get rid of any kind of dollar liability, floating rate dollar liability. So what they have to do is, what do they have on the underlying position? They are paying US dollar LIBOR plus 50 basis points. So therefore, one leg of the swap has to be such that there is an inflow of this which will cancel this outflow.
Yes.
Is this clear?
Yes.
First, make sure this is clear. Everyone should be clear about this. Sonam, what are you drawing? IRS. You're drawing an IRS chart. So please concentrate on what is being taught in the class. Okay? Is everyone clear up to this point? How the thinking will proceed? If you're working in a corporate treasury, how the thinking will, when you're doing structured transactions, okay, you should be clear about what you want to achieve. If you're clear about what you want to achieve, then you will know what to look for in a hedge transaction. Okay? You want to achieve a complete elimination of your dollar floating rate liability. Okay? So therefore, what you want to have is a situation where we are not dealing with exchange of principal. That principal liability is more complicated. We'll come to that later. Okay, let's assume that these are perpetual bonds. Okay, and there's no need to pay the principal. So we'll leave that. Just focus on the interest liability first. Okay, every 3 months they have to pay dollar LIBOR plus 50 basis points. They have no dollar revenues, so they want to completely eliminate the dollar liability. Okay, so therefore on one leg of the hedge transaction, they must receive the full amount of what they're paying in the underlying position. Is that clear?
Yes.
logically, okay? So I therefore must receive on the floating reg, I must receive dollar LIBOR plus 50 basis point, so that this inflow will cancel this outflow. Is that clear? Okay, so that part is taken care of. Now can they, of course ABC's XYZ would like it to be just that and they don't have to pay anything, but then Stanchart is not going to agree to that because it's a swap. So they also have to pay something, okay? So they have borrowed money, so they have to pay something, and what do they want to pay? They want to pay fixed rate sterling. So they will tell Stanchart that you give me a swap where I am receiving US dollar LIBOR plus 50 BP on the floating leg, and I am paying fixed rate sterling. Now you tell me how much fixed rate sterling you want me to pay. Are you following? When you ask somebody for a price, this is one way of asking for a price, okay? It's a slightly, this is not how market makers would ask for a price, but as a customer, you can always ask a bank for a price like this to structure the transaction, and give me a fixed rate sterling for which you are happy to pay, which is according to the, again, you see the idea of equivalence.
Yes.
If I am able to pay 10.5% sterling fixed rate, and receive dollar LIBOR plus 50 basis points, that means in the eyes of the swap market, these two cash flows are equal.
Yes.
Can we say that? Because they are being exchanged for each other.
Yes.
Okay? Is that clear to everyone?
Yes.
All in agreement?
Yes.
Can we say that? Vaibhav, you're not convinced. In any market transaction, okay, if you go and buy coffee for 50 rupees, then we can say that one cup of coffee and one 50 rupee note are equivalents of each other because you were willing to exchange it. Any market transaction that exchange happens where you can easily say that the terms asset and base asset are equivalents at that price. Okay, is that clear?
Yes.
Okay, so therefore we can, so therefore what they will say is, what the way that going back stepwise once again instead of coming to the answer, because remember that the objective of XYZ Corp is to convert their liabilities to fixed rate sterling. So they will want to do a cross currency IRS with Stanchart, and they will ask them this way, that you give me the sterling fixed rate that for you is an equivalent to dollar LIBOR plus 50 basis points. So essentially you give me a swap price, okay, it's a cross currency IRS that I want to do with you, and on the floating reg of the swap I want to receive dollar LIBOR plus 50 basis points. Now you tell me how much you want to receive on the, how much you want me to pay on the fixed rate sterling. This is clear? It's just like saying, I want to buy your house, you tell me how much, so I will take your house and you tell me how much money you want me to give. Okay, is that clear? You ask for a price in this way, like will you sell us bumper hull pen? You remember that case?
Yes.
What's that case which you did in contracts? Offer versus invitation to treat? Not Dawood. That is Harvey versus Facey,
Yes.
which is the first case you did on offer versus invitation to treat. So is this point clear to everyone now? Are you following? What?
Yes. So standard.
Yes. Yeah.
Standard Chartered Bank is asking XYZ Corporation to give it $150 million, and Standard Chartered Bank is giving.
No. There's no $150 million. That, forget about that 150 million. That is the principal raised in the, that is the money raised in the FRN issue. Forget about that. I'm now talking only about the interest flows. We are now talking only about the interest flows. Here you say, see in this middle panel we talk about periodic payments. Okay. So forget about the interest, the principal part right now. Okay, just focus on, let's not make it more complicated than it needs to be. First, let's be clear about the principal, the interest payments. Is this clear to everyone now so far? Are you following? Why the hedge transaction will be structured like this? Because obviously one leg of the hedge transaction has to be such that it completely cancels the dollar liability. So therefore, since they have an outflow on the dollar bond, they have an outflow of dollar LIBOR plus 50 basis points. Therefore, on the in the swap, one leg has to be such that they have an inflow of the same thing. Therefore, the inflow and outflow will cancel out. That part is clear. Now, if it's a swap, then they can't just be receiving on one side. They have to pay something also on the other side. So therefore, what do they want to pay? What is the net liability profile they want? They want to have a liability in fixed rate sterling. Right? So they ask the bank, because they have to ask the bank, because the bank is the other side, okay? I can't just say that I'm buying your house and like Feldhaus versus Bindley, I'm going to take your house and all I'm paying for you is 50 lakhs. Okay, I can't just decide it on my own. I need to have your view also because it's your property that I'm buying, right? So similarly, when they're entering into a transaction with Stanchart, if they specify that on the floating leg I want to receive dollar LIBOR plus 50 basis points, then they'll have to ask Stanchart, now what do you want me to pay on the fixed leg in sterling?
10.5%.
Okay, so then in this case, is this point clear how the negotiation will go? Okay, so therefore now then Stanchart has said that okay, you pay us 10.5% fixed rate sterling, that is good enough for us, we are happy to do this swap. Okay, so now if they do that swap, what is their net? So all I was asking was, now they've completed the hedge transaction, the swap is the hedge transaction. Okay, what is happening? What is the Tanvi looking at? Phone. What? Don't look down, look at what is being taught, okay? Because people are not able to answer questions. If everyone is able to answer questions very quickly, then I could still understand that you're so bored and you're so smart and you've covered everything so well that this class is a waste of time for you. But people are not able to answer questions. Okay, all right, so now, so this is the hedge transaction, the fixed rate sterling and the floating rate dollars. So this is a cross currency IRS, we call it a cross currency IRS because there are two currencies, okay? All right, so now I repeat my question, okay? Tanuj, I'm repeating my question. Now net of the, including the underlying position and the hedge position, okay? What is the net cost of debt, what is the net liability profile of XYZ Corp? By liability profile, I mean what currency and what fixed or floating.
Sir, I have not taken it.
Not taken yesterday's class. So, who will answer? Nagpal? Is my question clear? What is the net liability profile after adjusting the hedge position against the underlying position? What is the net liability profile of XYZ Corp?
10.5.
10.5 in which currency? Yes? Sterling, okay? So that's the correct answer, okay? It's very simple because this is just a matter of cancelling out the arrows, okay? Seeing which arrows are cancelling each other out. Okay, so the inflow of dollar LIBOR on the cross currency IRS cancels the outflow of dollar LIBOR on the loan. On the loan servicing side, the dollar LIBOR, both the flows are going to happen, okay? In that sense, in the sense at least the underlying flow will happen because that you can't disturb the arrangement with the FRN investors. So the principle remains the same, that when you hedge, you don't disturb the underlying position. So that arrangement remains the same. So this cash flow will have to keep on going to the bond trustee. Okay, you'll have to keep paying this money. On the swap, how the swap is settled is every 3 months. Okay, they will look at what is the dollar LIBOR. Okay, what is the dollar LIBOR fixing? What is the liability? LIBOR plus 50 basis points. They will look at the sterling liability, how much they have to pay, how much they have to receive, and then looking at the spot rate on that date, they will figure out who has to pay whom. Is this clear? Suppose you find 10.5% in sterling comes to some sterling, let's say 5 million sterling or something, and then the dollar part comes to $6 billion. Okay, so you use the sterling dollar spot rate on that day to figure out the dollar equivalent or something, and then find out who owes money to who, and there's only one payment. Okay, there's a net payment made to settle the swap, but conceptually you get the same effect. Okay, so therefore, as Nagpal has pointed out, so the net cost of debt for XYZ has now become fixed rate sterling at 10.5% fixed rate sterling. Okay, so now they have achieved the liability profile that they want, although they still have both the transactions on the books. They have the loan which has to be serviced, and then they have also the interest rate swap on the book with Stanchart. This is clear? Okay, so now they have achieved what they want. Okay, so this is the answer that I was looking for. Okay, I don't know why it was so complicated, but at least whatever it is, doesn't matter. But that's what this just confirms my instructions, just sort of validates my instruction that when you don't understand, a lot of the times you're not able to follow the structures, but you're not asking questions. So eventually you'll end up in trouble. Okay, so that's all we were saying. Okay, so this entire long discussion is just to give an example of what Debanshu was referring to yesterday. So once again, here we will say that the US dollar FRN that was issued, okay, at LIBOR plus 50 basis points, that FRN was a case of swap driven issuance. Okay, why do we say it's a case of swap driven issuance? Because this XYZ corporation had no natural interest to issue in floating rate dollars. They were only doing it because the investor appetite is only for that in that segment of the debt market. Okay, so we call these different segments of the debt market. They would have preferred to issue in the fixed rate sterling segment of the debt market, but the investment banker told them that there is no demand in that segment for your kind of $150 million worth of 7-year debt. Okay, but there is demand in the floating rate dollar market. Okay, so then they kept in touch with the investment banker, monitored the swap pricing levels, and they figured out that they could get a net cost of debt, which is, and remember this company, we have artificially said that this company's cutoff rate for debt financing is 11% sterling. Okay, so at 10.5%, it is still below their cutoff rate, so they can go for it. Okay, so they found out that this is the pricing. So they eventually, so why is this swap driven issuance in the US dollar bond market? Okay, and the US dollar FRN market? Because there is no natural desire on the part of the issuer to issue there. They're only doing it because that's where the investor appetite is, and they have a swap, a cross currency IRS sterling dollar, which allows them to achieve their cost of funding, the desired cost of funding in the desired liability profile, and that's why this issue happened. That's why we say this is swap driven issuance, in the sense it's not natural issuance in that sense. It's certainly artificial. Okay, is this clear to everyone?
So
Okay.
what is their hedge position?
Yes.
So what is their hedge position?
Hedge position is the swap.
The swap.
The position in the swap where they are paying fixed rate sterling and receiving floating rate dollars.
अच्छा वो वाली बच जाएगी उसमें से जो बच गया वो
Yes, so these two will cancel out.
हाँ वो बच
The
जाएगी
two flows will cancel out, and you will be left with the fixed rate sterling.
हाँ
Is this clear? Okay, so this is the hedge. So the entering into the swap is the hedge transaction, and the position that they have in the swap is the hedge position.
हाँ सर
Okay, so you can see that obviously XYZ, if you want to understand position, then XYZ's position is the opposite of SCB's position.
हाँ ठीक है
SCB has the opposite position,
हाँ
right? Just like when I buy dollar yen, if I'm buying dollar yen from you, I am buying dollars, but you are selling dollars. And after the transaction, that's a transaction. After we have done the transaction, my position will be long dollars, your position will be short dollars. What happened?
सर एससीबी की जो hedge position होगी
Speak in English. You give him the mic. Let's hear you speak through the. Where's the mic? Pass the mic and let's have him speak through the mic. This we have already covered in I think in IPM itself. The differences between hedge transaction, and we have covered it in IFM also. Be very particular about using the words transaction and position. A hedge transaction. If I buy dollar yen from you, I'm giving the example once again. If I buy dollar yen from you, okay, then the hedge transaction, I mean from my side, the transaction is a purchase of dollars, and the position will be the position that I have after that transaction is long dollars, and from your side the transaction is sale of dollars, and the position that you have after the transaction is short dollars. Okay, so we have to be very particular about the use of words. Many people in the market are not particular, but that's no excuse for you not to be particular. Is this clear? Okay, so that's what I was saying. So obviously in this transaction, SCB's position is going to be the opposite of XYZ's. That is always true, right? If you do a transaction with somebody else, then whatever your position is, his position is the opposite of yours. Is this clear? Okay. All right. So this is just to show you. Everyone clear about this so far? Okay. All to show you that swap driven issuance can also involve two different currencies. Okay, so all the references are given here, everything is given here, position, desired liability, position, profile, everything is given here. Now I'll just briefly, I did not want to do this, but I will just go through this because we have already covered so many of these. I think it's an opportunity to cover the concept of capital market, what we call capital market swaps. Okay, so when we refer to this here, okay, swaps here, we will talk about two swaps. Okay, you can see we will basically talk about two categories of swaps, and one of those categories that I'll come to later on when we do foreign exchange swaps will be other category. But right now what I'm covering with you guys is this concept of the what do you call, capital market swap. Okay, now this in the industry it's referred to, I just want to cover, there are 5 types of these. Okay, so I just want to quickly go through, it's very simple to understand. Okay, if you go through it logically, because I've already covered 2 of the types of swaps with you. Okay, we have already covered the fixed floating IRS in one currency, and we have already covered the cross currency IRS with 2 currencies. Already 2 types have been covered. So we might as well logically go through and see the other 5 structures. Okay, so refer to page 6 RMS, but before that let's look at, see TED. TED here means TED sheet in the calc file. Okay, in your calc file for this project. Okay, which is here. So let's just, so everyone understands the basic structure of a swap. Okay, now I'm calling them these capital market swaps. Let me just briefly write it here. Okay, this is the term I'm giving, this terminology, capital market swaps, because I want to distinguish it against, distinguish it with respect to FX swaps. Okay, the market is not that particular. I'm very particular about terminology. So in the market they will just refer to the, what I'm calling capital market swaps. In the industry they'll refer to it only as swaps. Okay, the reason I'm calling them capital market swaps, there's a reason for this, is that these swaps are frequently used. Okay, most of the usage of these swaps is in connection with the capital market issue. Either you had issued it immediate, you do the issue and immediately do the swap, or you've done the issue a few years ago. So there's always a capital market issue that is connected to this particular swap. Okay, that's why I'm calling them capital market swaps. You understand what I mean by capital market issue? This is the capital market issue. Can you see that?
Raising capital.
Yeah, is this a capital market issue? You're issuing debt in the capital market. So you will find that these types of swap structures, the basic structure of the swap is very simple. You'll have 2 different counterparties. See the basic structure of what I call a capital market swap, which the industry will call just a swap. Okay, so what is the basic structure? 1 counterparty on this side, 1 counterparty on this side, that you need for any transaction. Okay, 2 flows. 1 party is paying something and the same party is also receiving something. 2 opposite flows. Okay, all right. Then the other part is that what now the question is, we are going to now play with 2 things. We are going to play with fixed rates and floating rates, and currency 1 and whether single currency or dual currency. Okay, so the basic structure is clear to everybody. The basic structure of a swap, there will be 2 counterparties, and there will be 1 cash flow going to the counterparty and 1 cash flow coming from the counterparty. Is this clear to everyone? Basic structure, everyone is clear? No issues, Rahul? Clear? Okay. So now all we are going to do is, so I'm calling them capital market swaps because they're connected, always connected to some kind of, most of the time, about 90-95% of the time they will be connected to capital market issues, probably even more than that, 98% of the time. It's very unusual to do this without a underlying exposure in a capital market instrument. Okay, so here you have underlying exposure on account of the issuance of a US dollar FRN. Okay, that's your capital market transaction. That's why I'm calling these capital market swaps. Is this clear to everyone? Yes. If you say capital market swaps to somebody in the industry, you can explain it this way, because these swaps are always connected. They are done in connection with some kind of capital market issues. Now what might happen is, you may do the 2 transactions absolutely simultaneously, same day, same hour, or it may happen that maybe 2 years ago you issued a US dollar FRN. At that time you were not very concerned, but this is like a 7-year transaction, 7-year bond, a 7-year FRN. But now you've become suddenly very concerned about floating rate dollar risk. So you could do it after 2 years after doing the bond issue. But there's always a bond issue somewhere underlying to cover. Are you following what I'm saying? Okay, so that's why I'm calling them capital market swaps. They are connected always to capital market transactions. So let's quickly go to your spreadsheet, the FinCalc spreadsheet. Have I got, how did I end up with IFM calc? No, this is not what I need. Okay, I need the, yeah, let me just take care of this. What I need is actually FDRM calc. Okay, so we are going to just quickly, almost like in a logical sequence, we are going to just identify the 5 types of swaps that you can have, 5 types of capital market swaps. So we go to this sheet called TED. Can you guys all see the sheets at the bottom? Can you see, Ishan? So we go to TED where we had this LIBOR just using, okay. Now what are we going to do? This is the class. First let's get the conceptual taxonomy clear, and then it will be so easy to just structure out the transactions, okay? So capital market swaps, we are saying there could be 2 basic types, where both, we already know the structure of the swap, okay? 2 parties, 1 flow coming into this party and 1 flow going out of this party, okay? So we are going to play with 2 things. Either both the flows are going to be in one currency, or one flow will be in one currency and then one other flow will be in some other currency. So either the swap will feature one currency or it will feature 2 currencies. Is this clear? So we have a first level categorization. It will have 2 currencies or 1 currency. And then there are further, let's look at an example of 1 currency. Now 1 currency, now we're going to play with one more thing. So one variable we are playing is with how many currencies. Okay, so the first variable we are playing with is the number of currencies in the swap. It could either be 1 or it could be 2. Okay, the second variable, now let's go into the 1 currency category. Okay, under the 1 currency category there could be, now we have to play with one more variable. Now they have 2 legs. Now there are 2 possibilities. Both the legs could be one leg could be fixed, one is floating, that we have seen before. Okay, there's another possibility which you have not seen before. It's just both the legs could be floating. Okay, both the legs could be floating. So you could have, there's a name for this. This is called a cross-currency basis swap. You'll see all those names in the book itself. But the point is that you could have both legs as floating. So understand this. Like I think Sahil was asking about this LIBOR reference, why LIBOR reference. So if you have, for instance, the US markets, you can have many other floating rates. You can have a 3-month treasury bill as a floating rate. You can have CP rates. You can have 3-month CP rates. All right. So you can have all kinds of different different floating rates. So the point is that LIBOR is not, although LIBOR is the most common floating rate, okay, but it's not the only possible floating rate. You can have CP rates. You can have treasury bill rates. All of these are floating rates. Have you heard of bankers' acceptances? Banking, when you've done bill discounting? Yes. Okay, so bankers' acceptances are a form of bill discounting. Okay, it is basically all trade bills where the bank has essentially accepted that the bank will pay. So what you do is you get it. You have all these things like factoring. Also, you must have studied factoring.
Yes.
These are all examples of bill discounting kind of transactions where the particular party is it's like a negotiable instrument. Okay, so here bankers' acceptances means it's been accepted by Citibank that I will pay this liability on this bill of exchange. Okay, and then it will be paid in 3 months' time. So if Citibank is willing to pay, has agreed to pay in 3 months' time, then other banks are also willing to buy that instrument because it carries Citibank's credit risk. So they are okay with that. Is this clear? So you have various. The point to understand is that that LIBOR is not the only floating rate. You can have other kinds of floating rates. Okay, so let's just look at broadly, get an overview, and then so the way you can vary it within the 1 currency category, you can have 2 types of swaps. 1 leg is floating, 1 leg is fixed, or both legs are floating. It's clear? Okay, so we'll see the example. I'm just first giving you a broad overview, and then under the 2 currency category, you can have, obviously you can't have both legs fixed, because then there's no uncertainty in the transaction. Okay, so both leg fixed means there's no, everything is clear. You can't have both legs fixed in 1 currency. Okay, now here what happens is the second category is 2 currencies. Okay, 2 different currencies on the 2 legs. So the first category will be what you already saw on page 14. This is an example of that. What are we looking at? This category here, 2 currencies, 1 leg is fixed, 1 leg is floating. Can you see this here, guys? What is this? Can you see this? Does it fit that category? 2 different currencies, 1 leg is fixed, 1 leg is floating.
Yes, sir.
Clear? This is called a cross-currency IRS. You'll see all the names here. You don't need to write down the names, but you've already seen this example. Okay, what else? This is so mechanical that even without knowing anything about swaps, you can figure it out. Okay, that's why I wanted to go through this overview first. Okay, so 1 leg is fixed, 1 leg is floating. Then again you can have both legs are floating, which means here you will have one leg is sterling LIBOR, one leg is dollar LIBOR. This is clear? Both legs can be floating. Then here in the case of two currencies, you can have both legs as fixed, because here there is not perfect certainty, because if you are receiving 5% sterling and paying say 2% dollars, okay, when it comes, if it's a 10-year transaction, let's say the transaction is to be settled every 6 months, okay, every 6 months the sterling dollar rate is fluctuating, so the actual liability is not clear who owes money to who. The reason you can't have fixed, both legs fixed in one currency is
And this day-to-day marking is required.
not day-to-day mark to market. Actually, as a dealer, you will have to do day-to-day mark to market, not marking, mark to market, M to M. Okay, you have to say M to M. Okay, so or mark to market. So so is this clear that in a two currency situation you can have fixed rates on both sides, because it's not perfectly certain. It's a 10-year transaction. Every 6 months there's a settlement. Now sterling dollar rate is fluctuating, so you really don't know in advance who owes money to who. Is this clear? Okay. So these are your 5 categories. Conceptually, is everyone clear? Okay, these are the 5 categories. I'm covering this without covering foreign exchange swaps here, because these are connected. We've had a long discussion on debt capital markets, so I wanted to complete the discussion of capital market swaps, so you have a comprehensive understanding. Okay, so now you know conceptually there will be 5 categories of capital market swaps. So now we can go to this part. Refer to page 6 of RMS. What? You're getting tired. Everyone's getting tired. No, it's not acceptable, because you're adults and you're very young, so there's no excuse to get tired. What? Young and restless, whatever it is. Yeah, I think it's more restless than young, because I don't see any young in your behavior. I see only restless. So
Class is also getting heavy.
class is getting.
Heavy.
So class is always heavy. So you have to apply your mind. You've come here. You have come here. Have you come here to drive a rickshaw? You have come here to apply your brains. So obviously it's heavy. What did you expect?
So no class on Saturday.
1 minute. Okay.
So that means demanding finally.
System is demanding. Yes. We should. Would you like me to follow the dictate of the system? Okay, guys. So you can read this definition. This definition can probably be improved, but I wrote this in 1993. I had only 3.5 years experience at that time. So this is it's an okay definition still. Okay, you can read this definition. Now you see. Now what happens is, now let's learn the market terminology. Okay, let's learn the market terminology, and let's be clear about what. So conceptually, how you should think about capital market swaps is, you should understand why I've called them capital market swaps. Okay. And actually, another thing that I want to introduce, let's say without, okay, let me not complicate this at this point. We'll just, actually these are all interest rate swaps, okay? Although the market does not use that terminology. I'll show you why, because every transaction you'll see is actually this should be here. Okay, this you have to be a little bit careful, because all right, I am calling these transactions. So now when you study capital market swaps, you have to study it at 2 levels. Okay, this is part of your Tanuj has already passed out. Okay, so all right, so please make an effort to understand this, because later on it just helps you to understand overall. This needs to be part of your knowledge base in finance. When you're studying capital market swaps, I would like you to study it at 2 levels. Okay, one is I'm going to give you the correct taxonomy, which is what should have been used for conceptual accuracy, okay, theoretical accuracy. But then you have to also study, you have to also know what the industry uses, what terms the industry uses to refer to these. So just like I told you that I'm calling these capital market swaps to distinguish them from foreign exchange swaps. There's another category of swap, okay? but the industry will refer to these only as swaps. Okay. So similarly, I'm giving you another constraint now. I'm calling these, or I'm saying that all of these are interest rate swaps. Okay, I'll explain to you why later on. But in the industry, when you go, what will happen is these are called IRS. Okay, these are called interest rate swaps, and these are called currency swaps. Okay, so that is what I've used since this was being written in 1993, where I did not have this conception. So here I've written it from this point of view. You see interest rate swaps. So please be very careful here. Okay, I understand you're tired and all that, but just be clear, it's not that complicated. You have to understand this terminology at two levels. One is what is the conceptually, theoretically correct way to label these transactions, okay, which I'm giving you. On a second level, you have to also be aware of what labels the market uses to refer to these transactions. Is this clear? Both the levels, you can easily do it. It's not so complicated. Now these, the market calls interest rate swaps. When there's one currency, the market will call it an interest rate swap. Okay. When there's two currencies, the market will call it a currency swap. Okay. So this is all that is explained over here. You don't need to take any notes. I don't know, is the font big enough? Satyam, can you read this? You can't read anything here? If we make it 25. Now? Now? Okay. Alright guys, now let's try to see. I can't bring everything. So the first, you forget about, I'm just going to take it out. So that is IRS, the first. Can you see what this is?
No, sir.
You still can't read. Maybe you should come forward.
Yes, sir.
One step forward.
170.
What about you, Rahul? Can you read? Okay, so if Rahul can read, that means you come sit next to Jayant, you can read it. Okay? And where will Ishan come and sit in front of Dina? Then you can also read it. Come, both of you come forward. Sina, where will Sina go?
I can read.
Sina and Ishan can come here.
I can read.
No, you can't read. Are you sure?
Yes.
Okay. So Ishan, you can come and sit in front of Dina, and then Satyam, you can come and sit in front of Jayant. Don't waste time. Don't waste time in the class. This is also part of your professionalism. When the instruction is given, follow it. Don't create a drama over it. Okay, guys. Now quickly, let's finish this classification. Now you're looking at what the market parlance is. Okay, single currency. Read this stuff. Now let me rest my voice while you guys read these two things. Read these two paragraphs. The first category, I want to capture everything in one view, so I've had to leave out I have to cut off the top part of it. The top part is referring to IRS. The A and the B, above that you have interest rate swaps. Okay, these are interest rate swaps. I'm just pulling it up because I want to show everything in one view. Are you following what I'm saying? It follows what I've already shown you. You already have that conceptual diagram in your head. One currency and two currencies. Fixed floating or floating. That's all it's. Let's start with the first one. IRS, which means one currency. Okay. What is it? Floating fixed or fixed floating, which means depending on what you are receiving or what you're paying. Okay. It's the same thing actually. Floating fixed and fixed floating is the same thing. The transaction is the same. I'm just looking at it from this guy's point of view and then this guy's point of view. Okay. Okay. Now one floating rate and one fixed rate. Is this clear? One currency. You can see the classification, those involving only one currency and those involving two currencies. Okay. Here you have fixed floating and then you have interest rate basis swaps. Floating leg on both legs. Floating rates on both legs. So this category, floating, one currency. Here's where you have to be careful about the industry parlance. You have to know the industry terminology. These are called basis swaps. Okay, strictly speaking, interest rate basis swaps. So both legs floating, one currency. These are called interest rate basis swaps. Okay, this is the market terminology. What you find in the book is the market terminology. Okay, this is the market terminology in the book, so you should learn that also. But conceptually, you should also have this diagram in your head to understand this kind of taxonomy. Okay, now you can see these are called basis swap. These are called fixed floating IRS. Okay, this first A is called fixed floating IRS. Now go to currency swaps. Currency swaps, you have, if you have fixed rate on one leg, floating rate on one leg, see the category A under currency swaps.
Cross-currency interest rate.
Two currencies, two types of interest rates. This is called cross-currency IRS. Okay?
Circle swap.
Alright? So this is called cross-currency IRS. Now, here, these are known as also circus swaps. Okay? Now you have fixed. The second category is two different currencies, both legs are fixed. Okay, these are called fixed currency swaps. They are also called synthetic forward effects because you will see that there is actually a connection to forward foreign exchange rates, which we will see later when we study forward foreign exchange. This is effectively the same kind of profile as a forward foreign exchange transaction, but there is a cash flow difference. Okay, when the cash flows occur. In a forward foreign exchange transaction, the cash flow, all the cash flows occur.
What is called synthetic forward?
It's called synthetic forward effects because it has the same effect as a forward foreign exchange transaction. Remember, we have one category of transaction here under asset classes, markets and instruments. Okay, you have forwards, you have currencies and forwards. If you have a asset class is currencies and instrument is forwards, you can have an instrument called FX forward. Okay, FX forward transaction, very common transaction for corporate hedging. Okay, or institutional hedging as well. So therefore, this particular type of this capital market swap that I'm referring to, okay, this currency, which the industry will call a currency swap. Okay, this currency swap, where they have fixed rates on both the legs, and two different currencies. That transaction is called a fixed currency swap. It's also called a synthetic forward effects. Why? Because it has the same effect as a forward transaction, okay, but there is a cash flow difference. Okay, that's why it's called a synthetic forward effects. Okay, synthetic is meant to indicate the fact that it is not a direct forward effects transaction, but it is synthetically creating the same effect. Okay, all right. Okay, so are you guys following so far? This is the market terminology. And the third category is two currencies, both legs floating. That is called, what is that going to be called? Cross currency basis swap. All you have to do is read. You just have to read, but I think even now that is also not possible. Okay, so read this third category called cross currency basis swaps. Okay, so conceptually have this framework in your head. Under capital market swaps. I'm going to call all of them interest rate swaps. Okay, but that's not something that the market uses. Okay, so but then these are the transactions. Now what are these? These are called fixed floating interest rate swap. Okay, for the full, it will just be called IRS by the market. Okay, for short they will just call it IRS. Okay, but to be specific, you should say fixed floating interest rate swap. Okay, with one currency. Fixed. This is not. This is the market calls these IRSs, and these are called currency swaps. Okay, so let me just. All right. So here you have under IRS, you have two under interest rate swaps. You have two categories for the market. This is the fixed floating IRS. This is what the market will call it. Okay, and this both legs floating single currency. The market will call it a basis swap. Okay, so an example of a basis swap would be like, suppose here I'm just changing this. If I change this to floating, okay, then what will happen is, if I change this also to floating, then what will happen is this leg will be 3-month LIBOR and this leg might be 3-month treasury bill. Remember, two different rates. These are two different rates. Okay, so here you're actually playing on what is called the what spread is this called? 3-month LIBOR and 3-month treasury bill. No, this spread has a name.
It's a basis.
TED spread. Okay, so if you are doing a swap, so you can have an interest rate swap like this. It will be called an interest rate basis swap. One currency, both legs floating. One example is you can have 3-month LIBOR on one side and 3-month treasury bills on one side. Okay, all right. So this might happen if somebody wants. Somebody maybe raised some debt at 3-month LIBOR and he would much rather be paying interest according to 3-month treasury bills. So he will do a trade in which he will be receiving the 3-month LIBOR and he will be passing it on to his FRN investors, so that cash flow will cancel out. Get into this mode of looking at swaps as hedge transactions. Imagine there's a loan on the other side, there's a loan on your books and you're using a swap as a hedge. Okay, so if you receive 3-month LIBOR, you'll pay it out under the loan, and then you'll be left paying a net basis of 3-month treasury bills. You'll be paying interest at the rate of 3-month treasury bills. Okay, your view might be that 3-month treasury bill rate will remain much lower, and 3-month LIBOR might rise a lot. Okay, so this is the basis swap, interest rate basis swap, floating legs on both the legs, floating rates on both the legs. Let me change it back to fixed. Okay, all right. So interest rate basis swap.
So you said that
Yes.
in the diagram
Yeah.
was floating.
Sorry.
Sir, अगर
Use the mic. Use the mic. Use the mic and speak in English. Other faculty are also complaining that they keep on telling you to speak in English and you keep on speaking in Hindi.
no sir, today I am speaking in English.
Okay. What is it? Today some special occasion.
Sir, ये
Okay, go ahead.
sir 3-month LIBOR.
Mic is not working.
Sir, काम करें.
Yes.
Sir, 3-month LIBOR floating is there.
Yes.
So if SEB is paying to ABC is paying to SEB 3-month LIBOR, and so in return it is getting a 3-month treasury bill.
Yes.
So then there should be some basis points also, because the treasury bill is always lower than LIBOR.
No. That's the. I mean, basically, yeah. It will not be flat. It will not be flat. So if you agree to, I understand what you're saying. If you're saying that SCB has to pay, say 3-month LIBOR on the basis of 3-month LIBOR, and I'm not changing this fixed rate here, let it remain fixed, but we are going to assume it as 3-month T-bill, okay? Okay, so the exchange will not be equivalent, okay? So obviously if you are going to receive the 3-month bill rate, okay, and you are going to be paying the 3-month LIBOR rate, okay, you would want to have some kind of, because this rate is at a higher rate, okay, so you might want to have you would expect a LIBOR with margin, some margin below LIBOR. Okay, but then again your credit rating also matters, because it depends on what ABC's credit rating is. If your credit rating is very poor, because that will also get factored into the swap. If your credit rating is very poor, you might have to pay a margin above LIBOR.
That will be the credit spread.
Yeah, so that will be the credit spread over LIBOR. Okay, clear? Okay, so it depends on where it depends on what your credit rating is also. But you're right that the two rates are not equivalent. The two rates are not equivalent. Okay, right? Okay. So, all right. So, what are we saying here? Just quickly going through this framework and going through the numbers, do the names. This is called a fixed floating IRS in the market, or just called an IRS. You're following my cursor. This is called a interest rate basis swap. Under currency swap, this category is called currency swap by the market. And here you have a fixed floating IRS. This will be called. You can read all the terms from the book. Okay. This is called a fixed floating IRS. Okay. This is called a cross-currency basis swap. Okay, this is called a cross-currency basis swap, and this is called a fixed currency swap, also called a synthetic forward FX. Is this clear? Okay. Now understand why I am calling it interest rate swaps conceptually. Okay, why am I calling it conceptually interest rate? Now here's the problem. The market classification is understand this taxonomy problem. Okay, Ayush, you managed to score in the last over. This has been a long time. Ayush has not scored for a long time, which is very surprising. Okay, so like for a long, there was a time in between where Federer was not winning any tournaments for 2 or 3 years, and people said he should retire. But then he came back. Where is Ayush? Which group? Akanksha. Akanksha, you should put tape on his mouth. Okay. Okay. All right. Okay. So where are we now?
So we are at attendance.
1 minute. 1 minute. Oh, we have 4 minutes. 1 sec. 1 sec. Be careful. We have to use the time. We have to use the time well. Understand this logic very well. Okay. Why am I calling it interest rate swap? The market taxonomy. Okay. The market taxonomy, which you will see reflected in the book as well. Okay. That the market taxonomy is that these swaps are called interest rate swaps, and these swaps are called currency swaps. Okay. So understand this point. Now this is like if I classify I've already discussed this many times before, that if I classify this population into boys and girls, that means the boys are not girls and the girls are not boys. Okay, so if you're doing this, that means you're saying that whatever you're calling currency swap is not an interest rate swap.
Yes.
Okay, Now, what is an interest rate? If you take a simple plain meaning rule application of the interest rate swap expression, okay? What does it mean? It's a swap. You know what a swap is? A swap is an exchange. One party gives something and receives something else. So you are receiving and you're swapping interest rates, okay? And on the one hand, you're saying that any such transaction, you're calling it a currency swap, and the other category is interest rate swap. So therefore, this category is not an interest rate swap. But actually, if you see this, what is happening here? If you go to page number 14, you see this example that we looked at on page number 14, which is here. Let's look at this interest rate swap, cross-currency IRS. Now you know this is called a cross-currency IRS between XYZ and SCB. What is happening here? Is there an exchange of interest rates or not?
Yes.
You are exchanging interest burdens.
Yes.
You are exchanging one interest burden for the other. So there is always, in all of these transactions, if you can go back and perform a check for yourself, in every such, the 5 of these transactions, we discussed 5 structures. In every structure, there is always going to be an exchange of interest burdens, either in the same currency or in 2 different currencies. There is always an exchange of interest burdens. So therefore, all of these should be called interest rate swaps because you are actually swapping interest rates. Okay, so conceptually, the taxonomy that I've done here, this is the better taxonomy, that all of these are interest rate swaps, and just that you have to divide them in 1 currency, 2 currency, fixed floating. So this taxonomy which the market uses is not theoretically correct, okay, but the market is the market, okay, so the market has got used to this terminology. So when you go into the market, don't refer to a fixed floating IRS with 2 currencies. Don't call it an interest rate swap. You have to call it a cross currency IRS. Are you following what I'm saying?
Yeah.
So you have to study this subject at 2 levels. One is conceptually what is the correct answer, okay, correct way to look at it, and also you have to know what the market uses, what lingo the market uses, okay, because you have not come here to drive rickshaws, you have come here to learn how to think like an MBA finance student. Is this clear? Okay, you can get 20-40 seconds. All right, you can go. Any questions? Anybody? Anyone has a technical question? Sahil, you have a technical question in English? You have a question? Have a question? Bring the mic. Give him the mic. Let's record your question.
It is not good.
There is no such thing as a bad question.
Okay, sir.
Yes, you guys can go. The rest of you can go. The class is dismissed. Yes.
Sir, that you said in one leg.
Mic is not working. Use the mic because background noise. Yes.
Sir,
Use the mic.
I'm using the mic.
Yeah. So it is using. The voice has to come through the mic. Yes.
Coming now.
Yeah.
Sir, underlying position is 3-month LIBOR. In that cross currency interest rate.
In this example. Yeah.
Yes, sir.
Yeah.
LIBOR 50 basis points. It is the underlying position.
Voice is not coming through the mic.
So the underlying position. Now it's okay.
Yeah. Okay.
Yes, sir. The
Okay.
underlying position is 3 months.
Here.
Dollar LIBOR.
Underlying position is here.
Yes, sir. This is our underlying position. Our hedge position is the interest rate. So 10.5 is the.
This is the hedge position.
Yes, sir, the whole one.
This is not the hedge position. This is the hedge transaction.
Sir,
And this is also the position now. Yeah. I mean, net periodic payment position is this.
now the net is 10.5 sterlings.
Yes.
Now, sir, this net position can again be hedged by 10.5 dollar transaction, sir, because we have to pay in sterlings. But this is a US company.
No. The background I gave you was that XYZ is a British company with revenues only in British pounds.
Now, if the company would have been a British, a US company, then sir, this 10.5 sterlings will again have to be hedged by dollars.
No, but in that case, if they were a US company, they would have had some revenues, at least if not all revenues in US dollars. In which case, they would be happy with US dollar net because there's no liability mismatch. Right? Remember, the reason that XYZ Corp, being a British company, is going in for this kind of a convoluted structure is because they are only able to issue debt. The appetite for debt is only in the US dollar floating rate markets.
Yes, sir.
So they have to go where the customer is.
Yes, sir.
But that's not what they want to issue. They don't want that liability profile. profile. They want a liability profile which is fixed rate sterling. So that's why they engage in what is called swap driven issuance. They issue floating rate debt in US dollars, which is what they can afford to issue when the pricing is good. And then they use a cross currency IRS to convert their liability profile to what they want. Just desired liability profile. So you get to see how these capital market swaps can be used to hedge underlying loan positions, liability positions, and how the concept of swap-driven financing, how the capital markets are connected to the swap markets. All these things are important as part of your understanding of debt capital markets.
Yeah.
Clear now? Okay, good. All right. So you have a question, Dipanshu? You have a question?
Recording के अंदर ही बोल.
Let's include the question. I'm not going to stop the recording. Use the mic. Don't go in front of the screen. Yeah, go ahead. Use the mic.
It's not
Mic
just
is
a question.
not.
I'm
What
just
is
saying
it?
that
I can't hear you also because there's so much noise.
things are like over exaggerated. Like when you asked what is the net liability, I just thought there is something else than 10.5% euro. I thought there is something.
10.5% sterling.
Yeah, I thought there is something else which is related to the currencies, right?
Okay.
Because in certain situations, I have heard the banks does not give the LIBOR rate. The bank does not give the LIBOR rate after an extent of fluctuation. In certain cases, I have read that. So,
Bank does not?
sir, for example, this is dollar in euro.
Dollar?
They are giving payment in euro. And
Not euro, sterling.
Sterling. Okay. Sterling.
Sterling is not the same as euro.
So that is euro, right?
No. This sign is British pounds, also called pound sterling. This is also called pound sterling. This is not euros.
I just thought it's euro. So I thought that it is something to do with the bank condition that it may, say the firm that we will not be able to.
Okay, so you misunderstood my question on liability profile.
10.5 is obvious. It is
Yeah,
not,
but it was, even though it was so obvious, nobody could answer it.
I thought, how?
You can always take a chance. I'm not penalizing you for answering.
I just said 10.5 the first time.
But I didn't hear you.
No, you just said no.
I didn't hear you. Okay, I didn't hear you.
Answer
10.5. I never heard you.
Really, and I am sure my other classmates would also understand it's really not complicated at all. But I just think it is really over exaggerated. I mean, the words and the sentences are. So it makes a little complicated for.
Okay, I understand. But the point is, I did use the expression net cost of debt. You're saying the question was too complicated.
Yeah, and so the things are much more simple.
So that's what I'm saying. So you can see
It's just
diagram.
the matter of 5 minutes to like.
So what you're saying that this could have been covered much faster.
Yeah, and I don't think that due to maybe please don't get me wrong, due to your way of teaching, maybe much of the students are not able to understand. But I have done this before. So I have done the contracts.
So you're saying, see, the problem also is that the reason I'm using these complicated language and complicated words is that one has to also be very precise in what is asked, what is being
One can
asked.
step forward when they have understood the basic. Then they can just groom up your.
So you feel that these guys everybody in the class has understood all this?
I don't think. I mean, I don't say to them, but I just said that it is very obvious, and they were like, they don't know nothing what is going on. So I'm just saying.
Okay, no, so what you can do is if you feel that next time that when I'm asking a question which is where you feel that the language is too complicated, you can just clarify from your side. You can clarify that what are you actually asking. So you can always, like whatever you thought, actually I didn't hear you 10 and a half. 10 and a half I didn't hear when you said that. Okay, because if I was looking for 10 and a half sterling. So if I heard that, I would have already responded. That's why the moment Nagpal said 10 and a half, I pounced on it. Okay, so I was looking for that answer, but I didn't hear that from you. So, but if you have, so you can always say it again. I never put constraints on how many times you can answer.
No, I thought there is something else.
Somebody else said it.
No, something forward you are getting us to say. I thought there is something related to the.
It's okay, understand that you might have thought that the question is asking for a more complicated answer. Okay, I understand that. So next time if you feel there's anything which is more, this stuff is actually should not be so complicated, should not take so long.
In Hindi I told just Dharam what happened over the 15 minutes of class, just 2-3 minutes, and just he got it. I mean, this is the interest swap payments, one company is paying another.
So but the point is, see also that some of it might have to do with English comprehension.
Sir,
Some of it might have to do with
creating much of a problem, I guess.
which one?
I mean this thing, whole English thing.
But then the problem is you're in a business school, no? We cannot teach people in Hindi. We have to teach in part C. Basically what will happen is if you keep on having this, if you are being spoon fed in Hindi, what will happen is your English is not going to improve. Part of your training is also to improve your English comprehension. So like when you go to learn German, if you go to the maximum governments to learn German, the moment you enter, they will not speak to you even a word in English. Everything is in German.
That's right. And other teachers also do the same. They say us to speak in English, and we
They
do.
tell you to speak in English.
Yeah, they tell us to speak in English. But from your side, you can maybe just relax